It is a transition.
Yeah.
It is a moving into a different phase of life, but it's still active. You still have all of the forces of the economy working against you, if you will.
Our first one comes from Joe via text message, and he writes to us, I'm planning to retire next year, currently 61. I have nearly $1 million total in different retirement accounts, but I'm not sure how to adjust my investments as I get ready to retire. What changes should I make to my investment strategy? Well, the first thing we'd say, Joe, as John has already alluded to, don't change anything until you make a plan.
That's right. And Joe refers to the fact that he has investments in different retirement accounts. Well, that may be okay, but everything has got to harmonize. Everything has got to work together. So that all comes under the umbrella of the plan. You may have exactly the right investments that you need to have in retirement, although if you've been accumulating, I would challenge that premise. I would say that more than likely you need to change your investment strategy to conform itself to an income strategy as opposed to a growth strategy. And Scott, I think that people have a real hard time getting their brain around that because they've been in growth mode almost their entire life. They've been accumulating and putting money back and investing maybe aggressively over the years, but at retirement, it is, as Janet has said many, many times, it is like the difference in playing football and basketball. You can't play by the same rules because you get thrown out of the game.
Yeah, and here's the big example of that I've seen in the client meeting rooms when it comes to shifting that mindset is we will oftentimes see when someone comes to us the first time, if they're close to retirement, just like Joe, he says he's currently 61 and wants to retire next year. Oftentimes they'll come in, and if it's a bad market year, they've moved everything to cash or they've moved everything to risk-off investments because their mindset is, if I've saved $1 million, I can't afford to lose this because I don't have time to make it back. They're thinking about their retirement accounts, no matter how many there are, as one number.
That's right.
And that's the first thing that has to shift. It's not the asset number, it's the income number that matters.
Well, and what they're also doing is they're fixating on that retirement date, that 1 year, and they are actually going to live probably 25 or 30 years in retirement.
Right.
And so you have to have different investment strategies for different time periods in retirement, and that's what the whole income for life and the ready to retire process is all about, Scott, because we really do think that retirement is not a single event. It is a journey that you're taking, and you need to be prepared for all aspects of that journey. And that longer end of the journey, quite frankly, has to have an element in it of growth because inflation will demand that you have more income 15 or 20 years in retirement than you do at the start. I don't know anybody that would take a job and say, okay, I'm going to work for this amount of money for the next 25 years.
Yep.
And they just wouldn't do that.
Right.
And you can't do that in your retirement as well.
Yeah, I think about it, people think about retirement as a full stop, that's the end, but it's really just the beginning of something else. I tell people all the time when they say, well, hey, I'm not 40 anymore, I can't be in this investment strategy. Well, with a portion of your assets, you are 40 because you're not going to be using those dollars as income for potentially 20 years.
You said it. It is a transition.
Yeah.
It is a moving into a different phase of life, but it's still active. You still have all of the forces of the economy working against you, if you will, like inflation and volatility and all of that. And so you have to be in a situation where you can actually, like I like to say, you take whatever the defense is going to give you. If there's a hole there, you want to go exploit that hole if you're an offensive coordinator. And so that is something that I think most people don't think about. They think that the retirement date is the end, but it is simply the beginning of a new transition.
We call it the retirement red zone. If you are 5 to 10 years away from retirement, that's when the game changes. As John has alluded to, he used basketball versus football. I use just football. If you think about the red zone being inside the 20-yard line, offensive coordinators will tell you the play calling is different. The play calling is different because you have less field to work with. And when you are transitioning from accumulation into distribution, your investment strategy does need to change, Joe. So let's give you a few things to think about. We're not going to be specific with that because you need to make the plan before the actual investment strategy changes. But broadly and generally, we can talk about that. So when it comes to income, John, the first box to check is to figure out how much required income you need on a monthly basis just to pay your basic expenses.
You have to think about this in terms of what is it that you need that we would call essential income. The wheels are going to fall off the bus if you do not get this amount of money in the door every month. We need to know what that is. Now, you've obviously got Social Security, maybe a pension that would take up a good bit of that essential income amount, but there's usually a gap there. There's usually a deficit between what you have in guaranteed income sources in terms of pension and Social Security and what that required income need is. You also have to think about it this way. Your required income need is actually spendable money. It's not gross money, meaning before taxes. So if you need $5,000 a month, you're probably going to need a system to produce $6,000 a month before taxes, so you have the $5,000 to spend. That's rough numbers, but that's how you have to look at that.
Yeah, because the major risk here, you talked about inflation risk being huge. So is longevity risk. We don't know how long someone is going to live. And Joe, you could live a long life. You might not live a long life. But I always tell my clients it's better to plan for a long life and not get it than it is to not plan for a long life and get it. So to beat longevity risk, you have to have guaranteed income to cover your basic expenses. Now, beyond that, once that box is checked, because you may need to use some of your retirement assets to create more guaranteed income using a product such as an annuity, which we've talked about before on the show, and we can talk about again, I'm sure. But let's talk about the desired income part of that. So once that box is checked, we know your bills are going to be paid with guaranteed monthly income. What about the discretionary spending? And this is the dream part. What do you want to do in retirement? And putting a number to that, annual is fine, then divide it by 12. But think about your desired income and how that needs to be brought to you from an investment perspective.
Yeah, Scott, oftentimes, people think about their income as their income, but you've really bifurcated that, and that is an incredibly effective way to look at this. Your desired income is something that you're going to spend, and oftentimes we think about it in terms of how much the rest of the portfolio can actually support to maximize your income. Now, a lot of people don't take the maximum amount, but we try to display for them what the portfolio could actually support. The desired income really does, it's really the home of where our bucketing strategy aligns itself. And when we talk about a bucketing strategy, think about the timeline of your retirement from, let's say, age 60 to age 90. There's a 30-year time period. Let's break that time period down in about 5-year segments. And each of those 5-year segments needs to have a portion of your desired income money allocated to that desired income segment so that you can then invest according to your time horizon. For instance, money that you're going to use in the first 5 years of retirement to do your trips and things of that nature, that needs a very short time horizon, a very conservative time horizon. The money that you're going to need 15, 20, 25 years down the road, you probably want to invest that in equities because we need the effect of that income, those dollars invested in equities to have the opportunity to grow, to stay ahead of inflation. Scott, we've got a great graphic on the bucketing strategy that I think is really important for people to take a look at. When you think about this, if you align those buckets along a timeline, then the left side of the bucket strategy is low risk. That's money that you're going to use now or soon. At the opposite end of the bucketing array is the aggressive part of that. That is money you're going to use way later. That's money that needs to grow so that you can increase your income in 10, 15, 20 years down into your retirement. The middle bucket is a hybrid bucket, and you think about that with investments like real estate or a balanced investment portfolio that has some characteristics of stocks, some characteristics of bonds that create income. That hybrid bucket is a bit of a pivot, and that sits right in the middle, and that's more like a 10-year time horizon that you would use that hybrid bucket. But that's the strategy that we would use. And then if you're watching on Facebook or YouTube, you see see we have arrows coming out of some of those buckets and going into the low risk bucket. What that really means is that we are actually harvesting gains from the hybrid and aggressive buckets into the low risk bucket. Because think about it, Scott, if you are, let's say, 65 years old or 70 years old and you have a big gain in your equity bucket, if you leave it alone, it might disappear.
Yeah.
And you might not have the time to get it back. Right. You may pass away before the market ever recovers. And so you want to take that money off the table, so to speak, and put it and bank it into that less aggressive bucket, those conservative buckets, the low risk buckets, so that you can use that money to do the things that you want and need to do in your retirement.
So to wrap up, Joe, you need to be ready to retire. At Gen Wealth, we have the Ready to Retire process, and this is for Joe and anyone listening who's walking up into that retirement red zone. Walk through that with a Gen Wealth financial advisor. You can call us toll-free, 866-653-PLAN. That's 866-653-7526. Or send us an email, show@getreadyforthefuture.com, and tell us you want to go through the Gen Wealth Ready to Retire process. It's a planning process, and it can be a first appointment, and if you decide you don't want to go through that process, it's not going to cost you a dime. But we can talk to you about your goals, get a little information from you, and see if we're a good fit to work for and with you. Can you tell we like that question? That's what we do every day here.
We camped out on that for 10 minutes.
Half the show on that question. We may be dropping one, Casey. I can tell you that right now.